welcome to RJ Sanderson TV. It's the June edition. The end of the financial year is upcoming and Roy Sanderson is in the hot seat once again. Roy, welcome.
Hello, Dave.
End of financial year. The preparations underway for the end of the financial year for you and all of the team at RJ Sanderson.
Yes, busy time as we lead into June 30. It's busy pre-June as we do a bit of tax planning and post-June as we start getting into tax returns. You
usually celebrate New Year's Eve twice a year, once on December 31 and once on June 30, so some big celebrations underway. But before the celebrations kick off, Roy, this is actually an important planning time to make sure that people can capitalise on certain deductions and certain write-offs, as an example, this side of June 30, isn't it?
It is, and we're going to kick the show off with a few tax tips before we get into the economy and a few other things that we're going to talk about, property, shares. So it's a big show today.
As you mentioned, we are going to kick off with some tax tips. Let's get into the first one, Roy, because it relates to superannuation. And you've made a really interesting point here because, as we mentioned, the arbitrary sort of deadline for everything is June 30. People have June 30 in mind, but you've made this point.
Yes, a lot of people think the deadline to pay your super is the 30th of June. But the law and the legislation here is a little bit weird in that the tax deduction is only achievable if the super fund gets your money by the 30th of June, which means when it leaves your bank account, it needs to leave around about the 20th of June to actually be allocated by the super fund into your account. There's a thing called a clearinghouse, and I've complained about this before, but the reality is these clearinghouses hold your money before they shoot it off to the super fund and allocate to your account. These clearinghouses have no deadline as to when they have to clear the money out, and they can claim or earn interest on your money. So I hate this rule, but the reality is if you leave your contribution to the 30th of June, it's likely going to be too late. So get it out of your bank account by the 20th of June. Very important.
Another nuance of the deduction for super is this one, Roy.
Yes, you must lodge a notice of intent to claim super if you want to claim as a tax deduction. And your accountant should know this and they should let you know. The deadline to lodge this form is not the 30th of June, it's actually when you lodge your tax return for 2025. So if that happens to be September, October, November, whenever it is, that's your deadline to lodge this form for the tax deduction covering the full 2025 year.
Speaking of super, the co-contribution is another opportunity for some low-income earners. Talk us through this one, Roy.
Yes, if you have somebody in the household earning $45,000 or less in wages, put $1,000 into super and the government will give you a $500 co-contribution. That's a 50% immediate return. And if these are young people in the family household, it's a darn good return. So at least give that some thought and do that before 30th of June or, as we've just learnt, the 20th of June.
As you say, the co-contribution there, like the effect of that can be enormous if it's a 18, 19, 20-year-old. $500 compounding over the next 40 years until retirement, it's one that you want to take advantage of.
Absolutely, and I think when we look at our averages over a year, very few clients take advantage of that, and it's something that's not really well known. So at least look at it, and if it's not your family, you might know somebody who's working part-time in a friend's household that you should say, I've got some tax advice from RJS.
That's one of the good things to do. Now let's talk about some of the bad things to do. What are some of the crazy tax deductions that you've heard of recently, Roy?
Well, this is one that got released by the tax office and they let us know that there was a managing director working from home and he wanted to claim a coffee machine, a juicer and a treadmill. They did an audit. They discovered these deductions and they said you're not allowed to claim those. Now, had he been working from an office, not home, then he might have been able to claim these if he was supplying them to staff. But when you work from home, these items are not tax deductible. And that managing director should have sought advice from an accountant because clearly a qualified tax advisor would know you can't claim those when you work from home.
That one came from the tax office, Roy, but you know, during your time as a tax accountant over many years, what's an example of one of the stranger tax deductions that you've had?
Well, I had a primary school teacher who wanted to claim fish and a fish bowl And when I asked why, she explained that it helps the children, primary school children, learn how to look after fish, how to count because they were multiplying, and it all sounded quite reasonable. So I was okay with that until I asked how much she'd spent on the fish bowl and the fish. And each of these fish were $3,500. And I went, whoa, hang on a minute. They were exotic fish, and when I dug a little deeper, she was a collector. So she had these fish at home, took them into the classroom every now and then, and we had to unfortunately tell her they are not a tax deduction.
Geez, exotic fish. I never would have picked a $3,500 exotic fish as a tax deduction, but there you go. If you're thinking about claiming exotic fish, think again. Tax office won't buy that one. Changing pace to setting up a business. Roy, give us a little bit of information about what you need to do in this particular circumstances.
Yeah, sometimes we have people approach us, they've set up a new business and they're up and running and they want some advice around their bookkeeping or something. Before you start a new business, seek advice from an advisor because there are different structures that we need to consider. A sole trader, company or family trust. We need to do certain registrations, and unfortunately there's not one answer fits all. We need to ask some questions about your circumstances and how it relates to your tax outcomes that we're trying to achieve.
And another point that you've got here is on the personal liability of directors and people knowing that, I suppose, when setting up their entity structure.
Yes, and this is not very well known, but if you have a business that has data, like an accounting firm, we have tax file numbers, income details, you actually have to have in place certain cybersecurity protections, and if you don't, and your data is breached, you are personally liable. So the family home can be at risk. What it really means is that for anybody who's running a company that thinks the family home is protected, you should really check whether you've got the right cybersecurity in place. Go to our website if you want to look at some options that we throw up there under services and cybersecurity. So you just need to make sure you're protected because you don't want the family home to be exposed.
And I suppose, harking back to our previous conversation, Roy, cybersecurity costs, tax deductible?
Tax deductible to the business, yes, absolutely.
So incentive there on two fronts. Roy, it's not too long since the Stage 3 tax cuts were passed through the government, and let's get a little refresher on what those rates look like.
Yeah, I wanted to put this slide up because we know we had an election recently, and in that election there was some tax cuts being promised. Just bear in mind, it's not this tax return where they change. They do change from the 1st of July. We're going to get another $5 or $10. So these are your tax rates. Just have a look at that first. First band, $18,200, you pay no tax on that figure. And after that, it's 16% plus your Medicare. So it's really 18%. So keep those in mind because I've got some ideas, Dave.
Well, yeah, that's the natural question. What do you make of it? What do you make of it, Roy? If you were the Treasurer, what would you do?
Oh, well, this will not be popular, and I understand it's not popular, but I've got a theory that says that our GST at 10% is probably too low. We know that Croatia's 25%, Italy's 21%, the UK it's 20%. They don't call them GST over there, they call them VAT, value added tax. I think we should increase it to 15%. But on the back of that, we should change that tax-free threshold we just saw from $18,200 to $25,000. And that would save everybody $1,224 per year, which means you'll have more money to pay a higher GST rate. Now, before everybody gets upset about that, remember there's no GST on food, medical, etc., and that would stay the same. So not every item is going to go up in value, but some will. And the other thing I would do is, if I was Treasurer, introduce a tech tax. Google, Facebook, Netflix, they should be paying more tax than they do today. They have turnover or revenue of around $15 billion, and combined they pay tax of $254 million. That should be around $4.5 billion. So introduce some sort of turnover tax. Forget about profits for these big techs because profits are shifted offshore. Forget about that. New Zealand was about to do this sort of tax from 1st of July, but because of the Trump tariffs being threatened, they've dropped that as an idea. I think Australia should stand up and say these big techs, they need to pay a higher tax component.
Some big ideas and some big calls there, Roy. We don't have you on RJ Sanderson TV to make the soft call, so I appreciate it might be unpopular, the GST component, but I think it's an interesting suggestion and one for the politicians out there watching RJ Sanderson TV to consider. Let's turn our attention to some of the economic indicators, starting with the performance of the ASX over the last 12 months, Roy. We can see there that it's now starting to set new records once again.
It is, and we have a wealth management team that are across this all the time, and there's a few slides here I wanted to share. We can see the last 12 months was 10.8%. So you can look at that and say, wow, haven't we had a good year? We are back to record levels, and when we had a big downturn that you can see there through February through to April, everybody was worried how long that would drop. And if you just look at the next slide, you'll see that overall, our 20-year graph shows that we've actually been going up considerably. And I deliberately put the last arrow pointing up because we turned that April to May figures around and we're now trending back up. And the 20-year graph shows, despite downturns, it's always going to recover. You don't sell on a downturn, and the wealth management team are really big on that. So if you do panic a little, get some advice from professionals who deal in this space. Now, we saw a 10% return, and you might have said, wow, that's pretty good. But if that is the average, Dave, of 200 stocks, now, the average means you've got some shockers and you've got some really good ones. With good advice, what if you just bought the top 10 stocks? And here's an example of CBA, where CBA has had a return in the last 12 months of 45%. Remember, the average over 200 stocks was just over 10. So if the best one is 45, the worst ones are going to be very, very low, if a return at all. So I think the message here is you should see a wealth manager if you're investing, so that you're investing in the right things.
So Roy, if you're holding CBA stocks and you're sort of considering the tax implications, what does that mean at the moment?
Well, at the moment, you don't pay tax on that gain because they're not sold. You pay tax when they're sold. But one of the new regulations coming out for people with superannuation funds over 3 million is you pay tax on the gain, even if you haven't sold them. So here's an example. If you owned 1,000 CBA shares, your gain over that year is 45%. Your unrealised is 57,000 odd. You would actually pay tax of $8,600. So how are you going to get that money? It's not come from dividends. Your dividend return was $4,750 in that year. So you would be forced to sell shares. Apply the same logic to anybody who owns property. You own a property, if it goes up in value, whether it's 45% or just 10%, and you've got to pay tax on unrealised gains, it's just not realistic. It's a tax that shouldn't exist.
There you go. Some more advice there for Treasury and for the Treasury Secretary and for the Treasurer, in fact. Speaking of economic policy, a lot of economic policy over the last few years has been shaped around this number, the inflation number. But I think it's some pretty encouraging signs. It looks like it's flattening out to within the RBA's target of 2 to 3%, Roy?
Yeah, 2 to 3%, spot on, 2.4%. There was a lot of fear that the tariffs from America that are coming in might increase our inflation rate. I'm not as fearful about that, Dave, as I was originally, because the basket of goods that measures the inflation rate, there shouldn't be too much impact. There might be a small impact, but I don't think there'll be a big impact. So I just thought I'd throw that slide up so people can see we've ironed out inflation, and I think we'll see a very small increase in the near future, but not huge and nothing to worry about.
What about growth, Roy? I'm not sure that I'm not sure that this graph gives much hope, but at the moment, maybe there's a little sort of green shoot there at the end.
The big fear was that downward arrow on the right-hand side would continue and that we would go into recession, being a negative growth figure for more than 2 quarters. That hasn't happened. The best thing about this slide, which is over a very long period of time, it's 30 years, You can actually see there's a little uptick right at the end in the last two quarters, and I'm pretty pleased with that. So I'm expecting, because of these growth figures, because inflation seems to be under control, I'm expecting that interest rates will have more decreases in the future rather than increases.
Yeah, it's interesting. I think since our last show, Roy, there's been an election, and obviously the government was elected with a pretty clear mandate, and they've already put productivity on the agenda as a very big ticket item. It'll be interesting to see how they address productivity, because I think that is absolutely a hindrance to that GDP growth number, and the growth has been flat. It's been flat for quite a while now, and that's not just here in Australia, that's internationally. But I think it's going to take some pretty strong and pointed policy measures in the productivity space to start turbocharging growth again, and it'll be interesting to see where it takes us. And the government, now poised with a pretty clear mandate to make change on that front. It will be interesting to see where they go and what direction they go in on that front. Turning our attention to the property market, Roy, rental increases over the last 12 months is an interesting graph that you'd like to bring up.
Yes, 3.8% is the rental increases. You can see how it got up to over 9% a couple of years ago, post-COVID. And I just thought I'd mention that because rental increases are coming back to reasonable increases. And I think that'll continue to come down a little bit, because somewhere around the inflation rate of 2.5% is probably where you would expect it to fall. And I just thought I would share that because you have a situation where the average might be 3.8%, but Melbourne's rental increases are only at 2.4%. So, yes, certainly one to watch.
Rental yields also is another graph that relates to that, to the increases, Roy?
Yeah, so for those that don't realise, yield is, if you like, return on investment. So your yield or return on the cost of the property is hovering around about just under 4.5%, and in regional areas it's around 3.5%. And they're probably important because if you are going to invest in property, you need to consider what is not only my capital growth over time, but what rent return am I going to get. So that's why those graphs are important.
What about the exchange rate, Roy, and what that's doing at the moment?
Well, I thought I put the blue line across so you can actually see over the long term, and we're talking here back to 1990, so this is 35 years, we're probably close to average over that time frame. Started off high, certainly around 2011, they all jumped up. But the US dollar, euro and the yen, they're probably close to where they are from an average point of view. So some people panic about the exchange rate going up or down. I think we're just sort of levelling out. I don't see that we're going to have great increases or great decreases.
Okay, and just before we get to some of the viewer questions, Roy, can you talk generally to the home value index, because that's also quite an important measure and metric that we talk about? Yes,
we can actually see from the figures that have occurred, the average in Australia is 3.3%. House price rises, Dave, 3.3%. Now that's not bad. It's close to the inflation rate, so you might say that's normal. We're okay with that. But if you look at Melbourne is negative by 1.2%. It's the worst performing state in Australia. And that says something about our policies that the state government brought in Victoria. They are a concern. And I think Melbourne house prices are probably going to be flat for a little while. Some people are saying we're going to see a big increase in Melbourne. I don't. I think some of the policies are certainly long-term, and I'm talking about disadvantages to being an investor, and that's causing house prices to drop. So they'll stay low in Melbourne is my prediction.
Interesting stuff. Across the board, Roy. Right, we always have a few questions that come in from the viewers. And the first one, it relates to a self-managed super fund. How much do I need to commence a self-managed super fund?
Right, I have heard some financial planners or wealth managers say 500,000 or 700. ASIC have a guideline, and that guideline is 200,000 or more combined with your partner. So add them both together, Dave, and if you've got more than 200,000, you can open a self-managed super fund. Having said that, there's no legal limit, but to make it feasible from a return and cost point of view, you need at least 200,000. I wouldn't set up a self-managed super fund unless you talk to an advisor to make sure, one, you understand the rules, and two, you're doing it for the right reason. So talk to an accountant before you set up a self-managed super fund.
Just generally on that point, Roy, who are the type of, like, obviously you need to reach a certain threshold and number to get to open a self-managed super fund, but I suppose, you know, in terms of the type of people that might be interested in doing that, do you need to have a lot of time? Do you need to be someone who's a hobby investor? Like, why would you go and set up a self-managed super fund?
I would think that you wouldn't set up a self-managed super fund if you're going to invest yourself. So you need to seek advice. But we saw the average return for the last 12 months is just over 10%. There are some super funds, industry funds, making well under that, 6, 7, 8%. So you might set up a self-managed super fund if you want to get a better return and get more specific about where you invest instead of investing across the whole market. So you want a better return. Two, you might specifically want to invest in certain items such as CBA shares, or also maybe a property. And if you want to buy a property, you can do that via a self-managed super fund. You can't live in it until you're retired. So there's certain restrictions. Those are the people setting up self-managed super funds. Interesting.
The second viewer question comes in, relates to the age pension, Roy. A person is earning an age pension. Do they need to lodge a tax return?
Potentially no. Talk to an accountant to jump on the portal. Most accountants, I think all accountants should do this at no charge. Jump on the ATO portal and just double check your records. But if you've got no franking credits, that's tax credits from dividends that you've received, you don't need to lodge. Unless you've got that, you won't need to lodge. If you have a rental property, even though you're under the tax-free threshold of $18,200, chances are you will have to lodge a tax return. So age pension, it depends on your other circumstances. With no dividends, no rental property, just the age pension and some interest, you won't need to lodge a tax return.
Third question that comes in is about tax on an investment property. I have a family home which is principal place of residence and a holiday home on the coast. Do I need to pay land tax on the holiday home?
Well, the answer, unfortunately, is yes, you will, because you can only have one property that's a principal place of residence. But if you've got two properties and you've got a husband and wife, and those are in joint names, you should look at doing a little analysis. Should we transfer the family home, the principal place of residence, to one name and the holiday home to your partner's name? That will have two properties and each of you own a title. So you may be able to then have an arrangement where you each live in a property and you pay no land tax.
There you go. Some clever and nuanced advice there from Roy. Speaking of clever and nuanced, it's time for Roy's Rage. Roy, you're coming off the long run again. What have you got for us this week?
Well, this is the new proposed legislation. It says that if you've got $3 million or more in your super fund, and that's not necessarily self-managed, that's any super fund, you'll pay an additional 15% tax. I'm not completely against that as a concept. What I am against, two parts to this legislation. One, the $3 million only affects about 200,000 people today, but in 20 years' time, it could affect a lot because the $3 million is not indexed. I think it should be indexed. And the other thing, part of this legislation, is that they will tax unrealised gains. I talked about that with the CBA shares. It is wrong. It annoys me that the government think just because an asset's gone up in value, we can just tax that. It's not happening around the world. It's a very bad legislation, and I'm hoping the government will see fit and get rid of that. That's just not logical to do that, Dave.
So just for the people out there that are trying to understand unrealised gains, so you're suggesting that what's happening is they're taxing it on the total value of the super fund regardless of the state of sale, or regardless of its state. It's not in cash necessarily, it's in a fund or it's invested somewhere. You think that the tax should only apply once that's converted to cash?
That's the rules today, and that's the rules that should remain, because you're in shares or you're in property doesn't mean you've got the cash to pay tax. The tax should only be paid once you sell the asset. That's the way it should stay.
Roy, it's been fun as always. What's your advice, your closing piece of advice to people out there as we approach the end of the financial year?
Well, I think you should get tax advice. tax planning advice before June 30. If you want a copy of our tax tips, go to our website, email us, contact us, and we will send you a copy with some tax tips for this year. And make sure you do your tax return with an accountant, even if it's not RJS. Don't think you can do your own tax return and try and save a few dollars. It will cost you dollars. Get advice, because there's a lot of time and effort goes into what you can and can't claim for us as advisors. Don't think that you know it all, and do your own tax return.
Plenty of great info as always, Roy. Thanks for joining us on RJ Sanderson TV. And thanks for everyone's company in June. We'll be back in August with another edition of RJ Sanderson TV.